Hi, everyone. $21,000 every single year. The average American bleeds this much money maintaining assets that generate zero income. Meanwhile, institutional investors have surpassed $70 billion deployed into one ETF paying 3.8% dividends with double-digit payout growth. They are not buying more stuff. They're converting debt equity into cash flow. And in the next 8 minutes, I'll show you exactly how to transform $650,000 in possessions into $48,000 in annual dividend income. The math is proven, the strategy works. The opportunity is sitting in your driveway, your basement, and your brokerage account right now. The strategy Wall Street doesn't want you knowing. Retirement isn't about accumulation. It's about conversion. While everyone obsesses over buying more, saving more, owning more, smart money does the opposite. Liquidate, simplify, convert. The vehicle? SCHD, Schwab US Dividend Equity ETF. Simple math, proven strategy, massive opportunity. But first you need to understand what your assets are actually costing you. The cost nobody calculates. Ask yourself, what are your possessions actually costing to own? Not purchase price, ownership cost. Because the things making you feel wealthy are often destroying your retirement cash flow. Most people focus on what they paid for something. Smart investors focus on what it costs to keep it. The difference between these two perspectives determines who retires comfortably and who struggles on a fixed income. Debt equity number 1, primary residence. A typical home drains approximately $21,000 yearly. Property taxes, insurance, utilities, maintenance combined, 25-year retirement, over $525,000 in pure expense. Maintenance alone, nearly $9,000 per year. High-cost states like New Jersey and Connecticut, over $18,000 annually, just keeping lights on and roofs intact. Property taxes average $3,000, but many retirees watch bills jump from $2,700 to $4,000+ in under 2 years. Utilities add another $5,000 to $6,000. Insurance premiums keep rising. Homeowners associations charge more every year. The costs never stop. They only increase. Conversion math. Own a $500,000 house. Downsize to a $300,000 condo. Free up $200,000. Invest into SCHD at 3.8% yield. The first year, $7,600 in dividends. Historical dividend growth, 12.2% annually. Past performance doesn't guarantee future results, but applying that rate. Year 5, $13,400. By year 10, $23,800. And condo savings, $8,000 to $13,000 less in expenses. Total improvement, $20,000 to $25,000 yearly. Arithmetic, not theory. And you still own a home. You still have a place to live. You simply converted debt equity into cash flowing equity. Asset number 2, vehicle collection. Retirees without commutes somehow own 3 to 4 cars. Daily driver, SUV for trips, truck just in case. Each costs $2,000 to $4,000 yearly in insurance, registration, maintenance, even paid off. Insurance alone runs $1,200 to $2,000 per vehicle. Registration fees, inspections, oil changes, tire replacements, brake jobs, it adds up fast. And these vehicles sit in driveways depreciating while costing money. The alternative: keep one reliable vehicle, liquidate the rest. 2 cars worth $50,000 combined. First year SCHD dividends, $1,900 expense elimination, $4,000 to $8,000. Run through a DRIP calculator at 12% historical dividend growth. 20-year cumulative dividends, $106,000. Year 20 income, $12,000. One sale, perpetual income. You eliminated insurance headaches, maintenance hassles, and registration renewals while creating an income stream that grows every year. Equity trap number 3, vacation property. Vacation homes drain $10,000 to $20,000 in upkeep. The average use, 6 weeks, 42 days total. Cost per day of actual occupancy, $240 to $480. And that assumes nothing breaks. No roof repairs, no plumbing emergencies, no hurricane damage. Property taxes on vacation homes often run higher than primary residences. Insurance in coastal or mountain areas? Astronomical. the math shift. Sell $300,000 vacation home. Deploy into SCHD. First-year dividends, $11,400. Year 5 projection. Using historical growth, $20,000. With $20,000, rent luxury accommodations anywhere. Mountains, beaches, Europe. Different location every year. No maintenance, no property taxes, no anchors. Pure income and flexibility. You trade fixed obligation for freedom. Same enjoyment, zero headaches, growing income stream. Concentrated risk number 4, stock positions. Portfolio concentrated over 10% in one stock, gambling with retirement. Enron, Lehman Brothers, WorldCom, General Electric, Boeing, individual companies implode. Always have, always will. Company-specific risk destroys portfolios. One earnings miss. One scandal. One industry disruption. Your retirement shouldn't depend on one management team making perfect decisions for decades. SCHD holds 103 diversified positions. Largest holding, Merck, caps at 4.8%. Amgen, 4.6%. Cisco, 4.5%. Sector allocation, energy is 19%, consumer staples, healthcare, utilities, all defensive dividend growers. Every holding, 10 plus consecutive years of dividend increases. The fund itself, 13 consecutive years of dividend growth. Through recessions, crashes, everything. Converting concentrated risk into diversified income means choosing survival over speculation. When one SCHD holding stumbles, 102 others keep paying, keep growing, keep compounding. Business exit number 5, operating company. Business owners face brutal timing decisions. Wait too long, health forces fire sales. Exit strategically, maximize value, minimize stress. $600,000 business sale deployed into SCHD. First-year dividends, $22,800. Year 10 projection, $60,000. No employees, no payroll, no 60-hour weeks. Quarterly deposits, automatic. You built the business. You captured the value. Now let your dividend-paying companies work for you instead of you working for the business. The transformation calculation. Combined liquidation, house downsized, $200,000. Vehicles, $50,000. Vacation property, $300,000. Concentrated stocks, $100,000. Total freed capital, $650,000. At 3.8% SCHD yield, first-year dividends, $24,700. Historical growth projections, 12.2% annually. Past performance doesn't guarantee future. Year 5, $43,600. Year 10, $63,500. Year 15, $92,000. Factor in expense elimination, $15,000 to $25,000. First-year total improvement, $40,000 to $50,000. 5-year potential, $60,000 to $70,000. Strategic asset conversion, maximum cash flow, zero deprivation, same quality of life, better cash flow, less stress. The truth real estate investors hate. Primary residences aren't investments. They're liabilities masquerading as assets. Investments produce income. Liabilities consume it. A property draining $21,000 yearly while generating zero cash flow, textbook liability. Accept this reality. Convert accordingly. Real estate can be excellent investment when it produces rent, when tenants cover expenses plus profit. But your primary residence? That's consumption, not investment. Why SCHD works? Track Dow Jones U.S. Dividend 100 Index. Selection criteria, dividend sustainability, free cash flow, return on equity, consistent growth. Blue chip portfolio, Chevron, Coca-Cola, Merck, Cisco, Verizon. Quarterly distributions, expense ratio, 0.06%. $6 annually per $10,000 invested. Valuation advantage. Tech stocks, 28 plus PE ratios, SCHD holdings, under 17 average. Value, quality, income, growth. Single ticker. Institutional positioning. Over $70 billion in assets. Billions flowing in from institutional money. Smart capital isn't chasing AI hype or meme momentum, building dividend fortresses instead. When growth trades reverse, and they always do, defensive dividend payers hold firm. Income through volatility. Wealth through consistency. Institutions understand something retail investors often miss. Cash flow beats appreciation when you need to eat. Execution framework. Step 1. Audit assets. Calculate ownership costs versus income production. Step 2. Identify conversion targets. What drains cash flow? Step 3. Model scenarios. Drip calculators, projection tools. Visualize compounding. Step 4. Execute systematically. Plan transitions. Optimize timing. Step 5. Deploy into SCHD. Enable reinvestment. Activate compounding. The binary decision. Retirement measures income generation capacity, not accumulation totals. Struggling retirees, millions in home equity, can't cover property taxes. Thriving retirees, dividend streams outpacing inflation. Expenses covered, surplus remaining. 2 futures. Future A, high net worth, low cash flow, constant stress. Future B, simplified assets, growing income, actual freedom. Assets already exist. Decision is simple. The math is clear. Convert liabilities into income, stuff into dividends, complexity into freedom. Financial physics, not advice. The exceptional advantage works in any market, up or down. Dividend growth companies continue paying, growing, compounding. While others gamble on hype, you collect checks. Quarterly, automatically, perpetually. One question remains: what stops you? Disclaimer, this is educational content only. Past performance doesn't guarantee future results. Historical SCHD dividend growth doesn't ensure future increases. All investing carries risk, including principal loss. Consult qualified financial advisors before investment decisions. This is InvestED. Portfolio construction, surviving market chaos. Smash that like button, share this conversion strategy, and subscribe for wealth building intelligence. Converting assets into income. Investing smart. Profitable investing.